Hi everyone, hope you're all doing well. Today I'm going to talk about the 4 stocks that I have been buying. So I bought these stocks not last week, the week before. I've just been a little bit slow to update you guys, which I'm sorry about. It's just been a bit of a busy week in the stock market. So yeah, we'll go through these 4 stocks and I'll do a bit of a 3-minute, 4-minute video or talk about why I like them stocks and why I've been buying them. There won't be full deep dives in them because that will make the video very long. We're talking about a 2-hour, 3-hour video. So it'll be a quick talk over these companies. If you do want a full video on them, I probably have a full video on them on the channel, so do check that out. But yeah, we'll go through the 4 stocks that I've been buying and just keep up that transparency, because I like to tell you guys what I've been buying, what I've been selling, full transparency, because I know it's very frustrating to see other YouTubers potentially sell investments and then just sneakily sell it in the background and then never talk about it again. We don't do that here. I always talk about what I'm buying, what I'm selling, give you guys a portfolio review every couple of months as well, just so you know how everything's going. So I hope you enjoy it. Now, if you do want to know what I'm buying and selling in real time rather than a couple of weeks later than when it actually happens, the best place to be is on the Patreon. I post when I'm buying and selling in real time on there, and plus I put exclusive content on there. So last week I did 3 exclusive videos a week on there, and there's more regular portfolio updates on that as well. So for £5, Discord as well, 600 members onto, not bad value at all. It's probably why it's the highest patron to subscriber count on YouTube, which is absolutely amazing. So we'll get stuck onto these 4 stocks. So number 1, Inmode. So I've not bought this one for a while. Buying this one did mean I was averaging up a big amount though. I averaged up on this position. I'm currently up about 100% on this stock. And for me to average up on a position that I'm already 100% up on means that I see very much upside still in this stock. This is one of my more mature investments at the moment. So if you guys are probably new to this video, your first time watching me, basically I'm a long-term investor. I invest in these companies for 2 to 5 years, and then I look back at them in that 2 to 5 year range, and then I can work out, okay, did that investment work out? And for Inmode, it's working out obviously because we're up 100% in 2 years. But with this stock, I still think there's even more upside in the next few years, and even more than that is that I was actually more than 100% up on this investment. If we go back to November time, this stock was very close to breaking into the $100 mark, and since then it's had a massive decline of 60%. Now, with this stock declining 60%, I looked at this stock and went, there is no reason at all. This company has absolutely smashed it in 2021. There's no way that I find why this stock has dropped 60%, because even at these sort of valuations at $100, you know, a lot of these stocks have had these pullbacks because they got to overvalued valuations. With Inmode, it hasn't happened. Even at $100, this was still like pretty fair value. And now that it's fallen off this much, 60%, it's gone back down, should I say, into very, very cheap range. And that's why I'm very happy to still start building on that position more and more. So, I mean, the longer that it stays down this $30 range, $30 to $40 range, I will be buying this stock a huge amount. And this company is currently valued at only $3 billion. I think in the longer term, this is going to be worth way more than $3 billion. The tick symbol is INMD. And you'll see at the moment it's currently trading at 19 times earnings, which is incredibly cheap. You know, this is for a company, you know, when you talk about a 20 times earnings company, that's your average company on the stock market. That's your average company that grows maybe 2-3% a year. This company is not growing at 2-3% a year. It's doing way more than that. Then we're going to look at that in a second. Now, if you don't know what Inmode does, basically it provides a lot of treatments for different parts of your body, which make that part, whatever they're working on, look better. So, and a lot of this is done without having invasive surgery. So a lot of the times to have maybe your face look a bit better, body look a bit better, and maybe remove certain fat from a certain area on your body, a lot of the time you would have to go under the knife to have this done. A lot of this is done by more technology based, and basically, you know, you can walk in for this treatment, and when it's done you walk out, which you wouldn't have to do normally. So there's a lot of, it's very hard to explain every single treatment they do because they have got a lot of treatments now, but basically that's what it's built on. It's basically technology to help you look better without having the invasive surgery that you would normally have to do, which is obviously a big area. It's a growing area, and what makes it unique is that point of view. And I think that this has only just really been a newish company, and obviously it's mainly been in the US base. So the more this kind of ramps up and the more technologies they start to produce even more and more, I think it's a fantastic company right now. Now, some recent news that I haven't talked about before with this company is that they have just recently announced a repurchase program of up to 1 million shares. So this company is a growth company. It's a very profitable company as well. And now it's actually making that good amounts of profit that it can actually start buying back a good load of its shares as well, which is great to see. Now, recently what Inmode have done is basically they smash it every quarter. So they always come out with preliminary results, and then they actually announce their proper results. Now, the preliminary results are always the ones to go on from my point of view, because those are ones that kind of look at what analysts were expecting, and you look at the numbers that Inmode put in and like, wow, that was way ahead of what was expected. So it did, in the preliminary results, 46% year over year, and it will take its full year revenue range between 356 million to 357 million, and that was ahead of expectations. The consensus was 346 million. So you can see just in one quarter, it's 10 million ahead of where it was expected. Now, you've got to remember they've done this every single quarter this year, so that is the even more impressive in part. EPS, this is the profitability side of it as well. So they're going to do between 0.61 to 0.62 versus the consensus of 0.53. So yeah, that was way ahead from the EPS point of view as well. Now, from the outlook side of it, they reported their revenue outlook to be in the range of 450 million to 425 million, and the consensus was 422 million. So yeah, like even the consensus was in the range that was expected. The revenue was way ahead of what was expected. The profit was way ahead of what was expected. And then just to top it off, when they actually reported the next set of earnings, it was way higher than what was expected anyway, just slightly even more higher than what it was in that preliminary results. And this kind of leads me on to the point of view here, is that this is unbelievable. For a company that is ramping up that profitability a huge amount, the revenue is growing at 46% rate. Even next year, the growth is going to be a little slower and the profitability is going to be a little flatter. You look at this company down at 19 times earnings, unbelievable. And like I said, the company's dropped 60+% on the share price, and you're like, why? Why is it dropped that? It's not overvalued. The company is performing financially. In fact, it's way ahead of what was expected at the start of the year, and it's punished for that, and it's just absolutely bonkers, and this is why I'm buying the dip on this one. And if you look at the financials, look at this performance here from this company. Look at the profit growth, look at the revenue growth side of it. And this was at the end of 2021, and then when you get to 2022, the profitability is going to be a little bit flatter this year. It's still going to grow, but it's going to be a little bit flatter. And you've also got to remember that historically, Inmode do stand by guidance, so that's something to be key. But still, it's going to grow in the right direction. Revenue is still growing, and then in 2022 to 2023 goes back on the right direction as well. So unbelievable amounts of revenue growth, profit growth. Financial health wise, it's really good on the financial health wise. I mean, the cash balance is now 415 million. The thing is the Inmode produced that much cash now that there's so much going to that balance sheet. The balance sheet is so healthy. So it comes to the point of view, like, we talked about Inmode earlier, the buying back shares a massive amount, but there's still plenty of cash on that balance sheet. What have they got to do with that company? 400 million, and it's valued at 3.1 billion. The hike up the cash, the buybacks, potentially, is there a dividend coming? Are they going to potentially go buy another company out, which I think they mentioned previously? There's a lot of options here for Inmode further down the line. And as well as that, there's quite a bit of insider ownership in the company as well, which is great. Also being a founder-led company. So when you look at the metrics, the metrics are really cheap as well on this point of view. But when you look at the profit ones, it's the total enterprise value to EBITDA is down at a 13, for example, and we just talked about the P ratio as well. It's extremely cheap. So when I look at companies and trying to get a 2x return, like, I can easily see this with Inmode. Like, this is once again coming down to the valuations where I see potentially up to a 5x return in Inmode in the next few years, which is great. So yeah, I would love to get Inmode back into my top 5 biggest positions, potentially break it into my top 3 positions if I can. So that's number 1. Number 2, KBOX. So KBOX has had a massive amounts of bounce in the last few weeks. So this is a UK based company. The tick symbol is CBOX, and it is currently a 84 million company, which is very, very small. And that's why it can move so much, because it is a very small company. Trading down at 17 times earnings, once again below the magic number of 20. Dividend yield is 2.92% on this one, so you get a very healthy dividend yield as well on this company. Now, funny enough, when the stock was down here, I actually made a video talking about KBOX, and I was like, this is just absolutely crazy how this company has fallen off this much. Look at the run that it's been on, and then boom, it just fell down 50% on the share price. Basically meaning that the company improved, the fundamentals of this company over the last since 2018 have improved such an amount, and then the stock is basically flat. It's actually down since this time period, and I was like, this is just ridiculous. This is absolutely stupid. And it was funny to see like the negativity out there. Like, as soon as I made this video here going, this is so cheap, I saw the amount of people did the typical, like, the fear that we're in, the negativity that we're in, went, yeah, of course it's down, it's a terrible company. And there was so much negativity talking about this one. And within the next few days, weeks, what happened? Boom, 50% jump up. And this is what's going to happen to a lot of companies out there. A lot of them are so sold off, these jumps will happen. And this is the thing, is like, this isn't even back to like a decent valuation. This stock should easily be, pushing towards that kind of £3 range again. So this has so much upside, and it just makes me laugh. Like, when people see a dip like this, rather than going, oh, is this an actual buying opportunity in a company here? It's a pretty decent company. It's not badly valued, good growth, 2.9% dividend yield. Like, oh no, it's a terrible company because the share price is down. This is the opportunities that are screaming you need to be buying them, and that's what I did. And this is the rewards kind of coming in for that. Now, I guess, why did this drop off? Well, it did kind of get to extended valuations, but one of the big things is there was they got an error wrong with their actual earnings, so they got their inventory wrong, which is obviously not good. You don't want to be having errors like that, but at the same time, it's an inventory issue. It's not saying that profit was wrong, the revenue was wrong. When you have a company growing as fast as what KBOX is, and it's got a lot of franchise, potentially some of these things do come up, as long as it doesn't come a regular recurrence. And they have had a bit of reshuffle. They have moved the CFO on to kind of respond to that, and I think that's given investors a bit of confidence there. And when I look at this going, okay, yeah, you know what, they made a bit of an error with the inventory here. It's obviously not trying to forge numbers, because otherwise, if you're forging numbers, you'd be forging your profit and revenue. So I looked at that and thought, you know what, yeah, it's not good, but does it justify to go back to prices it was back in 2018? No chance. And that's why I bought the dip on that one. And I think that eventually people realised that, and obviously I think the shuffle in the management team helped, and we have had the bounce here. Now, just going back onto KBOX, this company historically puts good amounts of profit growth in, as you can see. And like I said, it's valued at what it was in 2018. If we look at 2018, they were doing 15 million, 2.6 million in profit. Now they're doing nearly 5 million profit and 29 million in revenue. So you can see here, the revenue has basically doubled in the last 3 years, and the profitability has basically doubled in the last 3 years. And it's valued exactly the same, which is just insane. And going forward, this company is going to grow earnings probably around about 10% rate. The revenue is still going to grow around about 10% rate, which is really good. So yeah, it's a pretty decent growth company, double-digit growth, and you also pick up a very good dividend. Financial health-wise, it's pretty strong on the balance sheet, as you can see here. As it's valued at 285 million, it's currently sitting on 5.6 million cash, and it does have a little bit of debt there. So yeah, I think that it probably will continue to pay that debt down a little bit. Obviously, it pays a lot out in dividend. You're picking up a very decent dividend yield up on this one as well. It's currently a 50% payout rate, which is very healthy. And as well as that, it's a founder-led company as well. So the co-founder CEO owns 25% of the business, which is really good. So if anyone's struggling or losing out the most from this share price drop, it's the founder. So he has, the biggest incentive to kind of get this company going back in the right direction, because he owns 25% of it. A lot of his wealth will be tied up in this company as well. So yeah, and then just going back onto the market cap history point of view, you can see here, it's currently valued. I can't get any more because it's locked on ticker. They only allow you to have the premium account to get these valuations for UK stocks. But from a market cap point of view, it's 85 million. That's basically what it's being valued at for such a long period of time. Even back down here at 2019, it was 63 million, so it hasn't really increased much on the market cap. So that's number 2, a very good profit company, revenue company, and I also pick a very good dividend yield up from that one. So that's number 2. The next one that we're very much known for, DraftKings. Of course, it had to come on this list. So I did buy some more shares in DraftKings. As you guys know, I'm a big fan of DraftKings, and I have currently got an average, I think, of like 42 potentially on this one. And, for me, when I was buying up at $60, I was like, okay, it is a bit of a fair valuation on this one. But, I've seen so many times arguing about valuation and thinking, this company's going to be massive in the next 5-10 years. Why am I arguing about potentially, buying at $60, $50 when, potentially in the next few years, this is going to be even, so much higher than this. So, I started by building a position in this, and I always had the awareness that potentially it drops down to, maybe $40, $30 potentially. But what has happened since then, it's gone down to $18. The stock's down 70%. And I'm just scratching my head looking at DraftKings going, okay, you're currently, the stock is down a huge amount at the moment. If we go from when it was $70, It's down 74%. I'm looking at this going, the market is currently selling at $18, one of the biggest TAM growers in the next few years, a company that's had such an impressive 2021. This company was supposed to do something like 750 million in 2021. It's just put 1.3 billion in revenue in. And the profitability side of it, people look at the marketing spend and go, oh yeah, it's just burning through money, without actually realizing why that is happening, without realizing it does that so it can take market share, and that market share then turns to profitability in 2-3 years time, which has been proven previously with the earnings results. They've gone from at the start of 2021 having 1 state profitable to now having 5 states profitable, and by the next at the end of this year it's going to have 10 states profitable, and it just blows my mind to see this company down at these sort of valuations. So I will just buy more DraftKings as I can. And like I said, the recent earnings this year were unbelievable. Like the Q4 was so good. They beat year over year. The guidance beat by 8%, which is fantastic. More states profitable, which is really good. And one of the really positive signs recently is that the insider buying is starting to really ramp up as well inside this company. Now, just looking at the financials point of view, you can see here, like on the total enterprise to revenue, it's down at a 3. This company was trading at the likes of 21, 22, 16, 12, 6, down at a 3. This for a company that's growing at 50 plus revenue growth, that has a clear path to profitability in one of the biggest TAMs ever, down at a 3. It's just crazy, absolutely crazy. So the thing is with this sort of company, it's like a KBOX. Like, yeah, sure, it's down at 18. It's massively sold off, but I don't look at that as like, oh, what a fail that's been. I've bought a company in the last 12 months, it's gone from 60 to 18. I look at that company down at these sort of prices and go, you know what? If you want to give me stupid prices, if you want to give me $18 for a company that's, doing so well, I will take it. I don't care that I'm down 50% on this stock right now. I will buy shares, and I will keep buying these shares, and I will accumulate shares, because I know in the long term, I will look back on this in a few years' time and go, do you remember when DraftKings was $18? And I will say, well, you know what I did is I did take that benefit. I did take that opportunity. I bought the shares, and I think at $18, you're talking about this stock. I can easily see in the next few years this stock going to $100 plus, and I will be buying these shares as much as I can, because I think that this is an amazing opportunity. So I don't care that I'm down on this position, and you know what? Down at $18, I don't look at this as a disappointment. I look at this as an opportunity, and I will be buying them shares in DraftKings. So that was number 3, and number 4 was Facebook. So with Facebook, I actually made a bit of an error. I should have been buying this stock a lot more early than what I should have done. Now, obviously, Facebook has had some problems. As you can see, it has gone from $378 down to $221, even when I was buying it a few weeks ago, because obviously this is not from last week, the week before. I was getting this even lower than where this is right now, which is mental. Now, when I was buying it, it was 13 times earnings. It's now 16 times earnings because it has gone up slightly. But the thing is, you talk about Facebook, even at 13, even at 16, it's incredibly cheap for this company. And when you look at Facebook, it's historically been such a good company. It's always had its doubters, but I mean, just look at the revenue growth, look at the profit growth. And sure, going into this year, it could be a little bit more of a choppy year for this company, but it's going to be, potentially just 1 year period of, not great numbers. You look at the long term, this company is easily going to go back to, putting in good amounts of revenue, good amounts of profit growth. I mean, financially, health-wise, this is one of the strongest balance sheets you're ever going to see. Currently they're sitting on 48 billion of cash because they produced that much profit. 48 billion, that's absolutely bonkers. That's the amount of companies you could go buy out, the potential of share buybacks that you do. It's such a healthy company, and the growth is still going to be pretty good going forward. And Mark Zuckerberg, who is currently the founder of the company, currently still the CEO, still owns 12% of this company. And the thing is as well with Mark is that he's always had his doubters, and what's he always done? He's always proved them wrong. And one of the big things that you would question now is the metaverse. Is that going to be successful? Is it not going to be successful? And even, they are putting a lot of money in it. But I mean, if that was to take off at the moment, it's going to be another massive part of the company going forward. But even the social media side of it, the 4 platforms I have, are still going to be massive growth platforms in the next few years. Now, obviously, why is the share price being spooked? Well, it's because of the future forecast. So they're currently expecting 3 to 11% year over year growth, which obviously is nowhere near what Facebook has done previously. That's near 20 plus % revenue growth. But let's say, that's a massive range, and let's say that even if they come in the higher range, 9, 10, 11%. And let's not forget, this is the first quarter. Realistically in the long term, this is probably going to, go back to a good, 14, 15% year over year revenue growth. Is that when you look at Facebook here, even if this company never gets back to the highs of what it was, even if this company grows, 12, 13, 14, 15% year over year growth, the profitability ramps up slightly, this company down at 16 times earnings is still incredibly cheap. And when you look at the numbers, total enterprise value to EBITDA is currently down at a 9, which is just insane. And for a company that grows at these sort of rates, down at a 9, I'm willing to take this bet on Facebook. The likes of Facebook, for example, I don't think will ever grow. You won't get crazy returns from this. But when you talk about a company that potentially in the next 2 to 5 years doubles up, these sort of prices, I easily see it. Even if they grow at that lower range, this company has come like a really good buy. So I am buying some shares in Facebook right now. So those are 4 stocks that I've been buying, a good mixture of growth, dividend, value plays. So hope you enjoyed it. Let me know what you've been buying in the comment section, and I'll catch you on the next video.